Imagine a company, posting this massive 29% revenue growth.
Right.
And they're sitting on a record backlog too, like $31 million in backlog.
Which is huge for a company of this size.
Yeah, exactly. But then you look at the stock, and they are trading at literally half the valuation of their peers.
It makes you immediately wonder, what's the catch here?
Right. You assume there has to be a catch.
Yeah.
So today we are opening up the Q2 2026 earnings call for BOSC to find out if this microcap is, well, a massive market inefficiency.
Or just a geopolitical value trap. Yeah.
Exactly. So welcome to this Talk Tickers Deep Dive. Our mission today is to just strip away all the noise, all the Wall Street jargon.
Just look at the hard data.
Right. For a company that operates right at the intersection of defense, supply chain management, and robotics.
The stakes on this one are just incredibly clear for retail investors, I think.
Oh, absolutely.
We are looking at a business that is flashing massive top-line growth, and they have all this contracted future money. But that momentum is, it's clashing head-on with some brutal foreign currency headwinds, and of course, the complex geopolitical realities in Israel.
Yeah, the signals are just deafening right now.
They really are. And we need to determine if this is a structurally sound hidden gem or if it's a trap.
Well, let's get straight to the scoreboard then, because we can't know where the stock is going until we know what it just delivered.
Exactly. Let's look at the number.
So Q2 revenue came in at $14.9 million.
Wow.
Yeah. Delivering a 29% year-over-year jump, and net income reached $1.4 million.
Which translates to, what, about 19 cents a share?
Yep, 0.19 per diluted share, which is a massive leap from the 0.8 million they posted back in Q2 of 2025.
That is a significant jump.
And gross profit margins also ticked up. They hit 23%.
Okay, that's really solid.
On the surface, sure, the top line explosion looks great, but okay, let's unpack this for a second.
Go for it.
I have to push back on that 29% number a little bit.
Okay, why is that?
Because, well, microcaps are just notoriously volatile, right?
Oh, absolutely. They swing wildly.
Right. So if Q2 of 2025 was just a disaster of a quarter, then a 29% bounce isn't really an organic structural explosion.
I see what you're saying.
Yeah, it's just a return to the baseline. They're just coasting on an easy comparison from a terrible quarter last year.
Right, the easy comp argument. Well, what's fascinating here is how management actually framed that exact dynamic on the call.
Oh, they addressed it.
They did, yeah. So Q1 of 2026 was admittedly quite soft for them.
Okay.
But that 29% surge we just saw in Q2, it did a lot more than just beat a weak comp from last year.
What do you mean?
It actually pulled their trailing 12-month revenue back up to match their all-time record from 2025.
Oh, wow. Okay.
Yeah, so this isn't just a fluke bounce, it's a structural recovery.
So they've completely erased whatever weakness they had and are back at their peak.
Exactly. And they are projecting that full year 2026 revenue will actually exceed their full year 2025 record.
Gotcha.
So that 29% figure, it actually represents real momentum carrying them past historical peaks, not just, filling in a pothole from last year.
Okay, that completely changes how I view that number. So they aren't just recovering, they're literally pacing to break records.
That is what the data is showing, yes.
Yeah.
And looking at operating income, they hit 1.1 million this quarter.
Right.
Compared to just 100,000 in Q2 2025.
Which is a huge difference, though you do have to factor in that impairment charge from last year.
Right. Good point. Last year's number was dragged down by a $700,000 impairment charge.
Yeah.
But even if we add that back in, for a clean $800,000 operational baseline last year, they're still up significantly.
Very true. And EBITDA hit 1.3 million, which is up from 0.9 million.
So the cash engine is just clearly running hotter right now.
It is. And the most impressive part is they are doing it without sacrificing pricing power. Right, because we saw that gross margin uptick to 23%.
Exactly. So the bottom line flow through is looking really solid.
Okay, but revenue doesn't just materialize out of thin air. It's not monolithic.
No, not at all.
And looking at the divisional breakdown, it reveals a pretty stark divergence in where that cash is actually coming from.
Oh, absolutely. It's a tale of three very different divisions right now.
Right. So BOSC operates through three main divisions. We've got RFID, supply chain management, and intelligent robotics.
Let's start with the clear winner here.
Yeah, the undisputed winner of the first half is the RFID division. That's their tracking tech.
Right.
That division surged 17.5% year over year.
Which is fantastic growth.
Yeah, hitting $7.3 million. And the CEO, Eyal Cohen, he noted this division is 100% tied to the Israeli commercial market.
Which is a crucial detail.
Exactly, because that sector had basically been frozen due to the geopolitical environment.
Right. I mean, we are essentially watching a compressed spring finally release.
That's a great way to put it.
Yeah. Projects that were, shelved or just indefinitely delayed during those initial geopolitical shocks, they're finally getting greenlit again.
They're turning the taps back on.
Exactly. And management expected this rebound. It started quiet, but the commercial demand is really pulling forward aggressively now.
As companies sort of exit their wait-and-see holding patterns.
Right. You can only put off essential tracking and logistics upgrades for so long before your business starts to suffer.
Okay, but here's where it gets really interesting to me.
Okay.
Because management spent their opening remarks on this call just hammering home their, quote, sustained defense demand.
Oh, yeah. They definitely push that narrative hard.
Right. But then you look at their biggest revenue driver, which is the supply chain division.
Right, the one that directly services defense.
Exactly. And it actually shrank by 5.8%. It dropped down to $18.6 million in the first half.
Yeah, it's a huge contradiction on paper.
I mean, how can you claim roaring defense demand when your main defense-facing division is posting negative growth? It just doesn't make sense.
On the surface, it definitely looks like management spin.
Yeah.
But when analysts pressed them on this during the Q&A, they pointed to customer consumption rate fluctuations.
Okay, translate that Wall Street jargon for us, because that just sounds like a fancy way of saying people aren't buying.
It does sound like an excuse, but in the defense hardware space, it's actually about timing.
Okay.
So BOSC gets their components designed into a specific piece of defense hardware. They are spec'd into the blueprint.
Right, they win the contract.
Exactly. But they don't control the exact week or month that the defense contractor actually pulls that inventory to the factory floor to build the thing.
Oh, I see. So the demand is locked in during the design phase.
Yes.
But the revenue recognition is inherently lumpy. It just depends on the defense contractor's own manufacturing bottlenecks or, their inventory drawdowns.
Precisely. They might have the parts sitting in a warehouse, and BOSC doesn't recognize that next wave of revenue until the contractor actually consumes them and reorders.
Okay, so it's a timing issue, not a demand issue. But how do we know for sure? How do we know they aren't just using this lumpiness as a convenient excuse for actually losing market share?
Because we have the backlog data. That's the proof.
Ah, right. The $31 million backlog.
Exactly. Think about the math here. They grew revenue 30% sequentially from Q1 to Q2.
Which means they fulfilled a tremendous amount of product in Q2.
Right. They shipped a lot of boxes.
Right.
But despite fulfilling all those orders, the backlog didn't shrink.
Wait, really?
Really, they replaced every single fulfilled order with a new one just to maintain that record $31 million peak.
Oh, wow. Okay, that is incredibly bullish. If demand was actually falling, that backlog would be shrinking as they fulfill past orders.
Exactly. And this backlog provides phenomenal forward visibility for investors.
Because it's guaranteed future money.
Right. And approximately 20 million of that backlog is explicitly scheduled for delivery by the end of 2026.
Okay, so let's do the math on that. Between the first half revenue they've already booked and that 20 million guaranteed for the second half.
Yeah.
They basically have line of sight on 91% of their entire 2025 revenue before this year is even half over.
Exactly. It completely de-risks the second half of the year.
And the bulk of that future contracted money, it sits in the supply chain division.
Right.
Which effectively neutralizes all that panic over the 5.8% drop in H1.
Completely. The revenue's coming. It's just a matter of which quarter it officially hits the books.
Okay, that makes a lot of sense. Now, what about their third division, intelligent robotics?
Yeah, this one is much smaller. They only pulled in $617,000 for the half year.
Which is actually down from $868,000 last year.
It is. But management has been pretty clear about the strategy here. They are using robotics to penetrate more defense factories with custom machinery. But it's clearly a strategic beachhead right now. It is not the primary cash cow of the business.
Right, they're getting their foot in the door with these defense contractors.
Exactly.
But the immediate threat to that cash cow, the real moneymaker, it isn't a lack of demand.
Oh, yeah. Definitely not.
It's the currency markets.
The Forex situation is just brutal right now.
It really is. So just to give our listeners some context, BOSC reports their financials in US dollars,
Right.
but they carry heavy local operational costs in Israel.
Because that's where their workforce and headquarters are.
Exactly. And the CFO, Moshe Zeltzer, he pointed out on the call that the dollar's devaluation against the shekel wiped out $600,000 in operating expenses.
And that was in the first half alone.
Right. I mean, for a company posting $1.4 million in net income, an annualized $1.2 million Forex headwind is just a total margin killer.
It's massive. They are essentially bleeding cash purely on the exchange rate math.
Yeah. It has nothing to do with their actual business performance.
No, it's purely macroeconomic. But management isn't just sitting there taking it. They are actively pulling the only two levers they have available to fight a currency drain of that magnitude.
Which are internal cost cutting and external price hike.
Exactly. So on the cost side, they are integrating AI tools across their software development and operational processes.
Yep.
The goal there is to lean out their workforce overhead.
Sure.
Basically, do more with fewer people to lower those local shekel-based costs.
Gotcha. And on the revenue side, Cohen actually admitted on the call that they've instructed the entire sales team to aggressively hike prices.
Yeah, they've been pushing those hikes since January.
Just trying to offset that currency hit.
And this is where the story gets really interesting from an investor perspective.
How so?
Because the fact that they can force those price increases on their clients while simultaneously growing the backlog to an all-time high,
Oh, what?
it tells us that their components are incredibly sticky.
That makes total sense. These defense contractors, they aren't walking away over a price hike.
No, because you don't rip out a certified integrated component from a military defense supply chain just to save a few margin points.
Right, the switching costs are way too high. You'd have to requalify a new vendor, test the hardware. It's just not worth it.
Exactly. That pricing power is a massive moat for them. And it's what allows management to confidently raise their full year 2026 guidance.
Right. They are now targeting over $51 million in revenue and more than $3.6 million in net income for the year. So with all that in mind, what does this actually mean for capital allocation?
That's the big question.
Because we have a $31 million market cap company, and they're sitting on $10.4 million in cash.
It's a huge cash pile relative to their size.
It really is. And they grew revenue 30% sequentially without burning any cash.
Which means they have highly efficient payables management, and they're probably using vendor financing to fund that organic growth.
Right. So are they just going to sit there and hoard that $10 million? Or is a shopping spree coming? Are we looking at imminent M&A?
Oh, they are actively hunting for acquisitions. Management said they are actually leveraging bank financing to create a $20 million M&A capacity.
Wow, $20 million for a $31 million company. That's a massive war chest.
It is, but if we connect this to the bigger picture, their discipline here is just ruthless.
In a good way.
Yes, in a very good way. They aren't just buying revenue for the sake of growth.
Right.
They require targets to be in AI, robotics, or RFID, and they must have 3 to 5 years of consecutive profits.
Oh, so no turnarounds, no cash-burning startups with a cool story.
Exactly, none of that. They want established, profitable businesses. Like the RFID targets they mentioned, they're eyeing for hospital penetration.
Oh, right. Expanding out of the Israeli commercial sector to diversify their geopolitical risk. That's smart.
Very smart. And the most important part is they're refusing to overpay.
What's their limit?
They are rigidly capping their target multiples at 5 to 6 times EBITDA.
Oh, wow. That is strict.
It is. If the market is frothy and sellers want higher multiples, BOSC just walks away.
And they have walked away, right? Haven't they been looking for a while?
Yeah, they've basically been walking away for 3 years straight because valuations were too high.
Well, I kind of love that. It protects shareholders from these dilutive, value-destroying acquisitions that so many microcaps fall for.
Exactly. It shows incredible restraint. And while they hunt for the right M&A deal, they still have organic catalysts driving growth.
Like what?
Specifically, their team in India.
Oh, right, the India expansion.
Yeah, they just secured $7.1 million in recent orders out of that region, plus another $4.7 million that's supposed to hit late summer.
And that includes a major semiconductor contract, right?
Yes, it does. And that semiconductor deal is crucial.
Why is that one so important?
Because in the supply chain division, getting designed into a semiconductor fab's product lifecycle, it basically means recurring revenue disguised as a hardware sale.
Oh, so it's that same stickiness we talked about with the defense contractors.
Exactly. Once you are spec'd into a fab facility, you become a permanent fixture. They don't want to change suppliers and risk downtime in a multi-billion-dollar facility.
Okay, so they have organic growth, a massive war chest, discipline management, and incredibly sticky revenue streams.
Right.
So let's bring this all to the bottom line. We have the numbers, we know about the Forex headwinds, and we see their M&A discipline.
Yep.
What is the actionable verdict here for the retail investor?
I view the current valuation as a glaring market inefficiency. It's a highly bullish setup.
Really, a glaring inefficiency. Break that down.
Well, let's look at the benchmarks. The Russell Microcap Index right now averages a valuation of 2 times book value and a 16 PE ratio.
Okay, so that's the baseline for an average microcap.
Right. Now look at BOSC. They are trading at 1 times book value and roughly a 9 PE ratio.
Wow. So you're basically paying half the multiple of a basket of average middle-of-the-road microcaps.
Exactly.
For a business that is hitting all-time revenue records and sitting on record backlogs.
Yes. It is a massive discount.
But why? The market usually isn't that inefficient without a reason. Why does that discount exist?
Well, it exists primarily because of liquidity.
Right.
Institutions often just can't buy a $31 million stock. The float is too small. If a big fund tries to build a position, they move the price too much.
They just ignore it.
Exactly.
Yeah.
And on top of that, you have heavy headline risk.
The Israel geopolitical situation.
Yes. If the shekel keeps strengthening against the dollar, or if the Israeli commercial market freezes again due to some sort of geopolitical escalation, their margins and that RFID growth are going to take a direct hit.
Right. The risks are very real.
They are. But at 9 times earnings, I would argue that a significant amount of that risk is already priced into the stock.
That makes sense. The market has already punished them for the geography.
Exactly. So for the retail investor who's seeking defense and supply chain exposure, this is a highly profitable, deeply discounted asset.
Assuming they can stomach the volatility.
Right, provided you can handle the currency swings and the geographic risks. It definitely requires patience.
Because the broader market is just clearly overlooking the underlying fundamentals right now.
Completely overlooking them.
Well, speaking of the market overlooking them, let's leave our listeners with this one final thought from the call.
Oh, this was such a fascinating moment.
It really was. So right at the end of the Q&A session, an analyst pointed out that their legacy legal name, Better Online Solutions,
Right.
is just incredibly awkward and confusing for what they actually do today.
Yeah, I mean, Better Online Solutions sounds like a dial-up internet provider from 1998. It has nothing to do with defense robotics or supply chains.
Exactly. And the CEO actually agreed with the analyst. He said they might just legally change the company name to match their ticker, BOSC.
Which would be a smart move.
It would.
Yeah.
But it really makes you wonder, you know?
Yeah.
If a company is throwing off record backlogs and posting double-digit growth,
Right.
but they are trading at half the valuation of their peers, simply because their legacy name is confusing retail stock screeners.
Right, people see the name and just scroll past it.
Exactly. Does that signal a massive pricing inefficiency that the market is simply too lazy to fix?
I think it just might.
It's definitely something for our listeners to mull over. Keep looking past the surface data, and we will catch you on the next deep dive.